Welcome back to Pie Uncut, the place where we break down timeless lessons from the world of economics and investing. Today we're diving into one of the most fascinating ideas in stock market history, Jesse Livermore's market key. Livermore, often called the Great Bear of Wall Street, was one of the most legendary traders of the early 20th century. His life was a roller coaster of massive fortunes won and lost. But in 1940, he wrote down his trading principles in his only book, How to Trade in Stocks. Chapter 1 introduces his secret weapon, the market key, and that's exactly what we're going to unpack today. Picture this. It's the early 1900s. No Bloomberg terminals. No CNBC. Traders only had ticker tape machines spitting out prices. Jesse Livermore believed that buried in those price movements was a hidden language, a pattern that revealed when the market was shifting direction. He called his decoding system the market key. The market key wasn't about predicting the future. It was about recognizing pivotal points, moments when the character of the market changed. Livermore's genius was in developing a framework to act on those moments with discipline. What is the market key? So what exactly is the market key? At its core, it's a way of translating price and volume action into signals. Livermore argued that markets move in waves, uptrends, downtrends, consolidations, and that these waves leave footprints. The market key helped him answer two timeless questions: when to buy, when to sell. Instead of trying to guess tops or bottoms, Livermore waited for confirmation. He believed that once a stock or the overall market made a decisive move through a key level, the odds tilted in your favor. That was the entry point. Pivotal points explained. One of Livermore's favorite terms was the pivotal point. Imagine a stock hovering at $50. For weeks it trades in a narrow range. Then suddenly, with strong volume, it breaks above $52 and keeps going. That's a pivotal point. Livermore would buy there, not because he knew the stock would skyrocket, but because the market had revealed its hand. Likewise, if a stock collapsed below a key support level, that too was a signal. In his words, markets are never wrong. Opinions often are. The price action itself was the truth. Lessons for modern investors. Now you might be wondering, does the market key still matter in today's algorithm-driven markets? The answer is yes. While technology has changed, human psychology hasn't. Price and volume still reflect supply and demand. And pivotal points? They're just as powerful today as they were 100 years ago. For modern traders and investors, Livermore's lesson is this: don't fight the tape. Don't predict. Observe and react. Use confirmation, not hope, as your signal. This approach can save you from the classic mistake of buying too early, selling too late, or stubbornly holding on when the market has already shifted direction. Key takeaways. All right, let's wrap up today's episode with the key lessons from Chapter 1 of How to Trade in Stocks. The market key is a framework for reading price and volume. Pivotal points matter. Wait for confirmation before acting. Markets don't lie. The tape reflects reality. Opinions are secondary. Discipline over prediction. Don't guess, respond. Livermore believed that anyone who mastered these rules could navigate bull and bear markets with confidence. And while he made and lost fortunes, his principles remain timeless. In the last chapter, we explored Jesse Livermore's market key, his framework for understanding price movements and pivotal points. Chapter 2 takes us deeper, showing how the market key works in practice. Livermore believed that theory meant little unless it could be applied. He explained that every significant market movement sends a signal. A breakout above resistance with strong trading activity is a signal to buy. A breakdown below support is a signal to sell. His approach was simple: don't anticipate, don't hope, and don't guess. Act only when the market itself confirms direction. This was the foundation of his philosophy. Markets are never wrong, but opinions often are. Instead of buying something just because it looked cheap, Livermore insisted on buying strength. When a stock broke through resistance and proved itself capable of moving higher, that's when he entered. He trusted strength over bargain hunting. In modern language, this is momentum trading, going with the flow of the market, not against it. The same logic applied when selling. Livermore refused to hold on to losers or average down into a sinking position. If a stock broke below a key level with conviction, he sold, even if it meant taking a small loss. He preferred small, controlled losses over catastrophic ones. Hope, he warned, was the most expensive emotion in the market. But Chapter 2 is not only about entries and exits. It's about how Livermore combined these signals with disciplined money management. He started small at the first sign of a move. If the trade went his way, he added more, pyramiding only when the market confirmed his position. If the trade went against him, he exited quickly, keeping losses minimal. This strategy ensured that his winners grew while his losers remained small. What made this approach so powerful was not just the rules, but the psychology behind them. The market key wasn't only a tool for timing, it was a shield against human weakness. By relying on signals instead of emotions, Livermore kept fear and greed out of his decisions. The lessons from this chapter are timeless. Act only on confirmation, not prediction. Buy strength, sell weakness. Never average down into losing trades. Add to positions only when you are right. Let price and volume, not emotions, guide your actions. These principles, set down in 1940, still describe the habits of successful traders today. Livermore's market key wasn't just a system of trading, it was a philosophy of discipline, patience, and respect for what the market is telling us.